Well, good morning, everyone. I have 10 o'clock, so I think we will start this edition of the Ag Economic Dialogues. Thanks, everyone, for joining us today. I will turn it over to Matt Diersen for some of the cattle insights and some pricing information for us. So thank you for joining us. And Matt, the floor is yours.
All right. Good morning, everybody. Unmuted, so now I'm going to try to. Oops. Heather, would you clarify that I'm actually sharing the slide deck, please?
You are sharing the slide deck.
All right, thank you. So this morning we'll take a few minutes and take a look at the current situation in the cattle market. But in particular, I want to look at calf prices a little bit, and then we'll look at just a couple of ways to protect calf prices. So calf prices are high, and what can you do when you're seeing high calf prices? So to kind of set the stage for that, I'm going to look at a couple of things. First, I'm going to kind of just jump back real quick nationally and look at the hay situation, because hay is a limiting factor, if you would, where you don't have feed or adequate feed supplies, you don't have expansion likely to happen. So here's a chart from the Livestock Market Information Center, or the LMIC. We can see here in 2021 versus 2020, a decline in December 1 hay stocks, and that's down around 80 million tons in the US. And you can see that a lot of years we have 100 to 110 million tons. So 80 million tons is a fairly tight supply of hay nationally. You can see here also that the LMIC provides a projection or a forecast for 2022. So December 1st, 2022 would be this last bar here on the chart. So they don't see the hay situation improving at all in 2022. So that's going to keep a lid on expansion on the cattle side nationally. Looking at, spatially, or taking a look at the distribution of the tighter hay stocks, you can see these large percentage changes in the supply or stocks of hay on December 1st across the northern plains in Minnesota, and then the extreme western United States. And very few areas have any kind of notable increase in hay stocks. New York State, for example, has got an increase there, but it's hard to get hay from New York to Western US ranches. So that I see as just an ongoing limiting factor, keeping a lid on cattle numbers or any kind of expansion plans on the cattle side. And that carries over into this next snapshot or picture here. This is the USDA baseline projections, and these are numbers that are released late October, early November. So these are on the website as of November, and they'll be formalized with additional text and narrative and stuff in the baseline report that gets released during February of 2022. But here we've got a couple of just a real simple snapshot. So the USDA baseline forecast for January 1 of 2022, or in a couple of weeks from now, does have the inventories going down. So the bars here are all cattle inventory, and they have that inventory declining into or through 2022 and bottoming out in January 1 of 2023. So decrease the supply and then have a turnaround. And corresponding with that is the price expectations. So decrease the supply of something, holding everything else constant, we should see an increase in price. The price projection matches that. They have calf prices going from last year in that 170 area to more like 180, 190 in 2022. And then finally in 2023, getting closer to 200. So just big picture, seeing an increase expected in cattle prices in 2022 versus last year and going forward for the next couple of years. And this would change if you had a rapid expansion in cattle inventory levels. But just to set the stage. So digging in a little bit further, let's take a look at the weekly 500 to 600 pound steer price. This price series, we've got this going back quite a ways, but here's the last 5 years in the very beginning of 2022. So end of 2021 over here on the right hand side, these yellow crosshatch lines here, the prices were around 190, didn't top 190 for the month, but good level of prices relative to what we'd seen in recent years. And then here at the beginning of 2022, there have been 500 to 600 pound steers selling for over $200, but quite a few are in that 196 range right now. So that's the level, or thinking about what would be a good price for calves, $2 or better than $2, because we've seen the price there or near that level. And prices in the fall of 2022, this time of year here, that's what we're really looking at. What are calves going to be worth late in the fall when the big runs happen in South Dakota late in 2022? So if those prices could be at $2 or better, that would be better for the typical seller or cow-calf producer in the state. So that's the picture, or the recent picture. Just a couple of observations, really. Seasonality gets talked about a lot. Here's the last 10 years of that steer price for a 500 to 600 pound steer calf sold in South Dakota. You can see the middle line there, the average seasonal price. So that's sort of, you just take the average for the year and then by month, and then plot the chart out here. It tends to be very, very, very flat. A little bit of seasonal downward pressure on prices in the last part of the year. But for the most part, you don't have this overwhelming strong seasonal pattern show up in the cash price for 5 to 6 weight steers. Now, there are another set of prices to take a look at. Focus first on the slide here. Focus first on the futures price. So this is a monthly average of the November feeder cattle futures contract, bolted year after year after year, going back to 2007. So it's always the average for the month of the November feeder cattle futures price. And you can see that currently, or right now here at the end of 2021, beginning of 2022, that futures price has been around $180, $182 a hundredweight, or the highest level seen since this period in 2014, 2015. And so that's what this price is. I've got another snapshot of this from our Bloomberg terminals. This is that same set of November feeder cattle futures prices overlaid by the life of the contract. So that contract tends to be listed shortly after the last one goes off, and then it's listed from the end of November of the prior year until the expiration, the middle of the month, November 15th, give or take a day or two of the given year. So the very highest price level on here would have been this period. Oops. Would have been this period here. The orange line, that orange line is from 2014, 2015. So end of 2014, the prices were at an all-time high, and they drifted lower throughout 2015 and ended up at 175 over here on the right. So that's a snapshot of all of the last 10 years of that November contract. So the current year is sitting here on this light blue line in bold that stops here on yesterday, November, on January 20th. So that is the November 22 feeder cattle contract that started or was first listed at the end of 2021 and is currently trading in that one. You can see yesterday it closed at 183.75 over here on the right. So the point of showing this is that this is the second highest level of feeder cattle futures available on record for producers to take advantage of. So the only time that prices have been this high this time of year in history was the 2014-15 year, or the beginning of 2015 was the last time prices were this high at this time of year. Now, also shown on this chart is the 10-year average. So just taking a simple average across those 10 years, Bloomberg runs this calculation, but you can see here this slightly darker, thick blue line going across the middle of the screen. That is the average of all those years. So if you want to think about, is there a time of year seasonally where there's a pattern in the feeder cattle market that'd be a better time or a worse time to do some pricing? That line looks pretty flat to me. It tends to be around 160 over the last 10 years without any strong seasonal pattern in that. That's good news. That means that the market is probably unbiased, and it's neither right nor wrong. It's not giving a premium for those selling early or giving a premium to those waiting to the last minute to sell feeder cattle. So it says feeder cattle are fairly effectively and efficiently priced throughout the calendar year, especially when you're looking at the November contract, which is the time of year or the contract likely driving or being a leading indicator of the value of 500 to 600 pound steer calves sold in South Dakota. So it's the benchmark you want to look at this time of year until you get enough volume in the March 23 contract to start using that as a guide for, what are prices doing or where are prices likely to be following corn harvest this coming year. So a couple things to just observe there. No strong seasonality, no strong seasonal pattern in the futures, and currently price levels are fairly attractive or fairly high. The other thing we kind of routinely track, and there is a little bit of a seasonal pattern in this, and that is the basis. The basis is the difference between the cash price and the futures price. And so here we have the cash price for 5 to 6 weight steers relative to the nearby feeder cattle futures price. Because we're comparing to the nearby and not to the November contract, if we're just comparing to November, we're comparing a fairly flat or non-seasonal cash price, the cash price for the calves, versus a fairly flat futures price throughout the year. However, when you compare the cash price to the nearby futures price, you're picking up a little bit of a seasonal pattern in the cash price for feeder weight or 700 to 900 pound steer calves. So that gets reflected in the feeder cattle futures price. So when you produce a basis chart like this, it shows a little more seasonality than it's really there in either the cash price or in the single underlying futures price. Clear as mud, right? Fun stuff here on a Friday morning. The point is, we've got some seasonality in there. And if we look at where prices are, we can see that last year, the basis on 5 to 6 weight steers was about $20 a hundredweight, October, November, compared to the feeder cattle futures price at that time. So that would have been the November feeder cattle for that month. That also means that cash price for the 5 to 6 weight steer calf was 112% above the feeder cattle futures. The other thing, if you were to look at how much change happens in between, for example, here in between November or June and November of that feeder cattle futures price, I just did a snapshot here. This is a series I've maintained for looks like quite a while now, but it just shows how much the futures price can fluctuate in between June and November. So that price can go up. You can see here in 2014, the price went up about $30 between June and November. In 2015, it fell about $45. So it's just another way to show the pattern that was in those futures prices that we're seeing a little bit earlier. So we've got that. Can be some changes, both the upside and the downside. And as a producer of cattle, cow-calf producer, these big downside moves are the ones to be concerned about, because it would be profitability that was eroded in the summer months probably in part due to the price of corn fluctuating during that time, but just to give you some visual snapshot of how risky that feeder market is. The other snapshot from Bloomberg here is a picture of the volatility. And, those that frequent the Ag Econ dialogues know that we're kind of look at volatility in different ways. Here I've got a longer run snapshot of the implied volatility of two price series related to cattle. The white line is the feeder cattle implied volatility, or the implied volatility of the nearby feeder cattle contracts, and overlaid with that, the extremely bright green line there is the live cattle volatility line. So you can see that over the last 5 years, that volatility as a percent would be around 10 to 20%. And if we look here where these big spikes or peaks occurred, that was March and April of 2020, or at the height of the COVID supply chain disruptions on the packing plants. And that pushed the volatility, which had been about 10%, up to 56% on the feeder cattle and almost 80% on live cattle. So for perspective, the lean hog volatility tends to be about 30% on an annualized basis. At the moment, both the live and feeder cattle volatility is down in the low teens area. So it's not at all-time low levels or something, but it's relatively low levels. So there's not excessive volatility at this time, meaning that you've got to do extra strategies to get around it. Volatility is low, so the cost of laying off the risk of prices at high levels moving lower is relatively low at this time. Also want to just point out, and maybe this is interesting to you as well, I was amazed at how closely these two volatility levels move together over time. It is the nearbys and such, so I guess it makes some sense, but to see them move quite in such lockstep fashion was a little surprising to me until I visually saw how it did behave month after month. So what could you do if you were a cow-calf producer looking to sell calves later in 2022? Well, if you did nothing, you would sit here with a relationship probably between the futures price and the cash price. This is a generic set of prices, so I've anchored it at $100 for no reason whatsoever, other than it's a nice round number. But if the price were at 100 today and you were to not do anything, you would have the risk of the futures prices or prices in the future falling, and that would be bad news for the seller of the commodity. If the price were to go up, you would be benefiting from not doing anything because you'd receive a higher price when it comes time to sell your livestock. So producers in the situation, we're talking about the producer with downside price risk at a future date, say selling calves in November. One alternative is to forward contract. So you could simply sign a forward contract and agree on a price and sell those cattle today. $100 could be your price. The price would be fixed. Generally, forward contracts only happen later in the spring and summer, and you do have relationship risk with that. So if you're a seller, you're counting on the buyer making good on the transaction, and there can be a little bit of a premium observed in the market. So with the forward market, there is some empirical evidence of a slight premium relative to the ultimate price received in the cash market by doing a forward contract. So it can be beneficial to the seller. You could also use futures. Futures, you have that same long cash position, but you're combining that by selling a futures contract, and going short futures would combine to give you an expected price, probably in line with the forward contract price. So selling futures is certainly another way to take advantage of high prices, especially in a situation where we have historically high prices on feeder cattle like we do at this time. A third option is to look at put option coverage. A put option is a one-sided contract where you say, I would like to obtain a futures price at this price or better, and you're willing to pay a premium to do that. So here's an example, a textbook example of how a put option would work. You'd observe the price today again at say $100, and you would give up a little bit of that price probably, and go down to a strike price. Here we have a strike price noted as B, very generic B, at about the $95 level here, just for example. And the difference between point B and point C is the premium, or what that put option would cost you to purchase today. So if you're looking at a situation where you obtain a floor price and pay a little bit for it, your floor price is here, you're paying a little bit to obtain the floor price. You can see the pattern then of the floor price creates this little hockey stick looking thing. And anytime the price falls below this point here, your gains from the put option offset your losses on the cash side, giving you a floor price, or the lowest price you're going to receive here. And that knocks out all of these low prices going forward. So put option is certainly a common and easy way to take advantage of paying a little to get rid of the worst downside prices. The nice thing about a put option is it doesn't lock you in. It leaves that upside open. So if prices were to run 10, 20, 30% between now and November, you'd be able to be in on any and all upside move in that market, giving it a huge advantage over the forward contract and future side. The third thing, I have to watch the clock here. The third thing we're looking at has been a recent adjustment really in an insurance product called Livestock Risk Protection. We've covered this several times the last couple of years on the different dialogues, but just to highlight some things, the coverage is available for fed cattle, feeder cattle, swine, and sometimes lamb. It's price insurance. It's very similar to buying put options, where you have a fraction of the expected ending price, which is tied to the futures price. And then the coverage is anywhere from 30 to 52 weeks. Well, here's a change or something I just want to highlight. It's been a change in the last couple of years. Currently, you can insure unborn calves. So that's different, and that's new for livestock risk protection, or newer for livestock risk protection. So you can buy calves where the calves are unborn at this time, and they charge you a rate that's consistent with, surprise, surprise, the expectation of 50% steers, 50% heifers when they are born. So you're saying, I'm ultimately going to sell my calves in November. So I'm going to look at coverage that ends in November, even though the calves are still haven't even been born yet. So yes, it will cost you more than waiting to buy it later on, but it is available. The other highlights with LRP that I want to draw your attention to, the premiums now have a 35 to 55% subsidy. So historically, this was only 13%. Now it's much, much, much higher, and it's greatly reducing the cost of coverage, and it's giving a huge comparative advantage of livestock risk protection relative to the outright purchase of put options. So large cost advantage. And then the other thing to highlight is that they have expanded out or lengthened the period of time to 60 days from 30 days, that the coverage is still in place if your end date comes around. So historically, that would be a tight situation. So if you were to face a unusual dry conditions or unexpected dry conditions, and you had to sell the calves earlier than expected, you might be outside of your 30-day window, and you would have to convince the buyer of the cattle to also try to buy your insurance policy, so that one of you could claim the difference or its expected value. That's been widened out to 60 days now, giving it, again, it's just a huge advantage for livestock risk protection coverage that wasn't there a couple of years ago. Here's the premiums, just to show you that the premiums do go up, increase as the coverage level goes down. So the less coverage you're buying, the more it's subsidized. To just just further encourage some level of protection. And as you get to low levels of coverage, you're not getting much coverage. It's not costing much, and it's highly subsidized. So it's very, very affordable to get very low levels of coverage. And the higher levels of coverage are still going to cost you more or a little bit more. And that's just to both encourage, but not give the coverage away. The sales trend, this product is very popular in South Dakota. And once that premium subsidy jumped from 13 to 30 and up to 50% from 2020 to 2021, you saw what happened nationally. We went from covering a couple 100,000 head to covering close to 1 million head. South Dakota's right there. This is year to date 2022. So we're on track to, for only 6 months of the fiscal year that this is on, well on the way to exceeding the number of head covered last fiscal year. So it's become popular, and it's becoming more popular. So hopefully people are hearing about it. Here's the full snapshot of the last full fiscal year. So a year ago, about 150,000 head of feeder cattle were covered in South Dakota, which led the nation in terms of the state with the most coverage. But for comparison, year to date, we're close to that. They'll probably see that exceeded for the fiscal year of 2022 at the same time. So 150,000 head. The South Dakota calf crop is in the neighborhood of 1.6 million head. So it's still not every critter being covered, if you would. How does LRP work? You've got that same long cash position. So if you don't do anything and the price of calves goes much, much higher, goes to 300 instead of 200, you're in on all of it. At the same time, if you see the price at 100 here or $200 cash today, there's a chance that price could go down. So livestock risk protection works like this. You observe the expected ending price, shown here at point A, $100, just arbitrary. And off of that, you have a coverage level. So you take some off to select a coverage level. That coverage level can be 100% or 99.9%. But you take something off for the coverage level, and then you pay a premium, and the premium is subsidized. But it still needs to be considered, because even a subsidy, you're still spending, I'll show you, it's a high amount of money for 9 months or 12 months of coverage on a feeder weight. Those combine, though, to give a livestock risk protection or an LRP floor. That LRP floor is my language or my terminology, just to show you that, hey, that picture looks exactly like buying a put option. So if the subsidy was very small or negligible, those would be exactly like one another. Here is a snapshot of the other day, the coverage levels and premiums and floor prices available for mid-November expiration. So this would be what would be available right now to insure a calf for sale in November. You can see here that the premiums, because the subsidies decline a little, the subsidies increase with the coverage level going down. The premiums get smaller and smaller, but even at the highest coverage level, the premium gives you an effective floor price of $185, which would be higher than the calf price received by most producers last year in November. So at the moment, even paying for the high premium levels for those unborn calves, you're looking at a better floor price than received, and there's a chance then for price protection. So if you wanted a floor of, say, 180, that would be very possible or feasible. If you wanted a floor of 170 with very little outlay in terms of dollars per hundredweight today, you could have that protection in place and have upside open in that feeder market. That's what I had for prepared remarks. If you want some more information, here's my contact information, email, and the office phone. And we include this, our extensions here for anyone. who would like to take advantage of our services. So that's what I have. Heather, questions?
Okay, thanks, Matt. As you guys know, Matt usually has to leave the dialogue session and go teach class right away. So if you have a question that you would like to ask him, it's a little harder to leave them till the end of the recording today. So if something comes up as Jack is going through his presentation, shoot us an email or put it in the chat box and we'll get it to Matt if you have a question that comes up in a little bit. So otherwise, thanks, Matt, for the information. That was pretty cool little diagrams and stuff that you had today. So I
Yeah,
will.
Bloomberg's fun, isn't it?
He does a lot of things for us.
All right,
So
thanks, everyone.
I will now turn it over to Jack Davis and we'll give him about half an hour here for some of the information that he has. Looks good, Jack.
Okay. Yeah, my title probably doesn't fit what we're talking about, but I'm going to do some finance stuff and then still hammer home on probably some of the input cost. And if I got time, we'll take a look at some land values too. So it's stuff that I've been sharing this week as I've been out on the road, and I thought it would be good to talk about here too. So. Just contact information and I'll have it again. Of course, I'm out of the Mitchell office, and email or cell phone is easy ways to get a hold of me, or the office phone. So many of you that follow or have been part of the dialogues know that we use, or I use, what's called FinBin, and that's a group of farmers that participate in a record-keeping organization and submit their financial records cost data to that organization, and then it's pooled in the FinBin database, which is housed with University of Minnesota. So I got a couple sets here that I looked at and queried, and it's Minnesota, North Dakota, South Dakota, and Nebraska. This first set is a 2,000 to 5,000 acre farm, and then we'll do the same thing looking at 1,000 to 2,000 acre farms. And I'm just looking at 1 year here and separated out three sets of quintals. So the low and upper is that 60 to 80% level of net income, and then the high is the high 20% of net income in that group. I did pick on crop farms. That doesn't mean they don't have livestock, but that's not a major portion of it. It doesn't change a lot for those, but I was focusing on crop farms in these that I'm going to present today. If you would have questions or wanted some specific, more different than what I've done here, we could probably do that for you or your group. So be sure and reach out to us if you're interested in something different than what I show today. So just here's the acreage, and of course, as they go up in acreage more towards that middle range, it's not surprising that they end up in that higher percentage of net income. The crop acres owned a little bit of difference, but it's still kind of below that 25%. We get to the 1,000 and 2,000 group, that is right around 25 to not quite 30%. I was surprised when I pooled this data or queried this data, was the machinery investment per acre was higher for the high net income group. It usually hasn't been that way. Usually they're fairly even, and many times the lower net incomes have a higher investment. So for this year, it showed up being higher. Another thing that was different, many years when they do this, or just pulling a single year, there's not a lot of difference in yield. In 20, there was. So, and of course, then the higher yield is the higher net income group. In both corn and beans were higher. Wheat was not too much different. And also somewhat higher price, especially in corn and wheat, than the other lower groups. But probably one of the big things that I want to show from this slide is what's the operating expense ratio. Let's see if I can get my mouse to go down there. And that is calculated by taking total farm expenses, less depreciation and interest, and then dividing it by gross sales. So a couple ways to think about that. So if we're at a 65% level, it's saying that it's taking 65 cents to generate $1 of sales. Another way to look at it is, out of each $1 of sales, I have 35 cents left to pay for my interest and principal, because principal is not an expense item, so that's not in there. And then any reinvestment or withdrawals that I take for family living. So those items would have to come out of that 35 cents. So thinking of it that way, when you start getting up above that 70, and especially when you get in the 80 level, that's not leaving a lot of money to take out for withdrawals or pay down debt and interest. So as in your own operation, you'd like to see that probably below 70, and the lower you can push that, and is the better off for profit in your operation. Another thing, and I'll show a chart on growth rates as we get done with this stuff, is a change in earned net worth. So I'll show that chart will show if we were able to maintain this level of, say, reinvestment, how long would it take us to double? And that's an interesting, I think, chart, is I look at these different levels of amounts that were earned in net worth. So earned net worth is meaning that they've paid all the expenses, taken the withdrawals that they wanted, and kept that money in the business then. So they've actually earned it. It's not a change in market values of assets, but it's cash that they've earned or income that they've earned and been able to keep in the business for that year. So on this side, what I want you to pick out is what's called term debt coverage. It is a ratio that says, okay, how many times let me back up. Do I have the ability to pay all my expenses and then cover my term debt? So if it was at 1, I can pay all my expenses plus my withdrawals that I take for individual or partnership and cover my term debt payments. So you want to see that at least at 1.5, and 2 is better. And we can see that on this upper end, they are well doing that in 2020. Debt to asset, how much of the business does your creditors own would be one way to look at it. So in this low income side, our creditors have the majority, slightly, of ownership really in our business. So they become very interested in how things are working when it gets to that level. We're kind of pushing it at 40, but many operations run that. And if they're doing an expansion, sometimes that runs that 40%. maybe up to 45, and then the stronger ones are able to make that work and get it paid down. A very comfortable rate is right around that mid 30 or 30% debt level in the farming industry. I like a working capital to gross, and you want to see that for your operation probably right at 35. And how that's calculated is it's working capital, which is current assets minus current liabilities. So that's working capital. And then for this measure, it's divided by gross. And I'm using gross income. Some use expenses. You'll sometimes see it working capital as a percent of expenses. And either way is fine. I would just say be consistent in doing it however you would choose to monitor your operation. Like I said, that one you want to see probably at that 35 when we're talking of gross sales would be a good level to be at. And we can see here, then I just broke it down into a dollar amount per crop acre for these operations. So at this mid one that I have here, it's at $255 per crop acre that they have in working capital. So really the ability to pay their upcoming expenses for the year. Same thing, just switching now to that 1,000 to 2,000 acre crop farms. And again, a single year. And I was again surprised at how much difference there was in our machinery investment per acre. I haven't dug into that anymore. I just was surprised at it. These guys owned a larger percentage of their acres than the 2,000 to 5,000 acre farms. In working with operations, many times in South Dakota, we see that those that own, 40 to 50% are pretty strong operations, or tend to be. Again, in yield was quite different. Many, like I said before, many years it is not. It was in this year. Price then received was also stronger for corn and wheat. Fairly even on soybeans, and even a little bit less on the high income side. Operating expense ratio, again, pretty strong on this upper 20% and the high 20%. Change in earned net worth was very strong. So in this year, they were able to keep a lot of it in their business and grow the net worth. Term debt coverage, pretty strong. Of course, the low side was, they're suffering. They'll have to either get better or possibly get out in when they're at that level. It can't continue that way very long. And they're pushing here that 45%, and then the high right at 30. Very strong working capital to gross, and there's the dollars per acre. So in your finance, there's a rule of 72, and if you take your earning rate and divide that into 72, that's how many years or the time period that it will take to double that investment. It's just a rough rule and an easy way to measure, and I just wanted to show it graphically. I started all of these out at a net worth of right over 3 million, and at that high level, this 17%, that's at not quite 5 years before that doubles. So we'll take him out here to the 6, and then if we do it again, another 5 years or so, we're out at 12 million, and it just keeps going up. I guess what I wanted to picture is that if an operation is able to do that, and it wouldn't even have to be at these strong levels. This was a pretty good year for these upper levels of net income. You can just see how fast they can grow, and comparing it to those that aren't able to keep as much in their business. They either have to take it out as withdrawals or not as profitable. And I just wanted to highlight that in a graphical sense to show that possibility of growth. We just I pick on what I call the top 5 for expenses for farms or crop farms, and this is for growing corn. And it's seed, fertilizer, land cost or rent, machinery, and then a management. And these 5 tend to make up about 80% or so of expenses, in no matter which the size. A couple of these, are variable. These others would be fixed for the most part, or have a variable and fixed component to them. Oops, I did not mean to do that. Don't think, yeah, okay. So then I just will break these down a little bit and look at them individually here. What we've taken here is cash rents divided by corn yields. And this is cash rent according to USDA National Ag Statistics for South Dakota by county, taking the yield that they're measuring by county and the rent that they reported by county. And I went back to 2008. I called Eric at our USDA office in Sioux Falls, and they were able to send me that fairly quickly or easily. And so that's where we went back to, was 2008 for the rents and the yields. And not surprising, it comes out the way that you would kind of expect for South Dakota. These are the different counties that I used. I know the colors aren't real distinguishing, but Moody and Lincoln are up in this upper end in yield and rent, which to me makes sense. And we'll look at it a dollar per bushel in our next slide. But as you really east and south, probably you're more consistent on yields and higher yields. So probably less risk in paying those larger rents. So here it's just looking at the amount of rent per bushel of corn yield. And again, same way. The higher yields and more consistent yields really ends up being a higher amount per bushel. Then I took it for the farms that were in the database that I queried, and just show it how it fluctuated throughout the years. And to me, it's saying that this 2,000 to 5,000 in the mid-level of income was maybe chasing those rents. They had the higher cost per bushel all the way through this time period. So to me, they're trying to grab those extra acres, maybe not as profitable of acres, to maintain that size. That's what I'm inferring from this graph. Seed cost, I I should present this a little different. Another way that I like to look at these is take each line item and divide it by gross. Well, for seed, before 2011, 12, before that time period, back into early 2000s, seed costs ran about 11%, 11 to 12% of gross. And then in that 12, 13 time frame, it jumped 2 percentage points to about 14 to 15% of gross. And it took probably up till 18 and 19 for that to drop back a little. And it still did not drop back to that 11%. So seed corn companies were able to capture a larger percent of farmers' gross dollars. And not saying that that's wrong, doesn't mean that you don't want to spend money on seed, but you got to know what seed works well for you, what varieties, what numbers work well on your farm and your ground to get the most out of that you are spending on it. Machinery cost is really all over the board for different operations. I know they're all kind of tight on this one, but as an individuals, and not necessarily these that are in here, we really see it vary from operation to operation. Can they do much more of their own repair? Do they have to send it to a shop? Are they running older equipment? Are they running newer equipment? Is the equipment fully employed? In the full employment of equipment, or that investment in equipment, is what I see as probably being key. And that doesn't necessarily mean that these operations have a full line equipment, but they're able to fully utilize the equipment that they do have. And I've seen that go both ways, even on large operations where they may not do their own harvesting, that they hire that done from custom operators. Now, the key to that is having good custom operators in your location, and that those custom operators can get it done well and in a timely fashion. And I've also seen it in manners where maybe they didn't have the acreage to fully employ that equipment, but then they went out and picked up custom work to fully employ it and make it work for their operation. And then just our management and labor charge that we see. Probably I have them in cents per bushel here, probably around that $30 to $45 per bushel is kind of where that shakes out. But not per bushel, I said that completely wrong. Per acre is where that falls, and again, that's quite a range too. I took then the total top 5 and then the price per bushel that they received over this time frame, and projected out or estimated what it was this year and projected out for what we are seeing as we're buying inputs coming up. This is, like I said, this is about 80% of total expenses. So coming into this year, I see farms as taking on more risk as we go into production, which just same type of thing that happened back in here when things started to escalate in our dry years, that when our input prices took off. And we had that probably pretty good profitable year if you had the yields in 20 and 21. And then this is getting a little tighter coming up in this year, coming forward here for 2022. we're getting close to, I have a lot more material that just is other stuff, more on fertilizer. I'm going to skip through that. I want to share some things at the end on let me think here. Renewable diesel. And it's something that's starting to be talked about if you're attending different seminars or things. It's different than biodiesel. In renewable diesel is termed a drop-in fuel. So it can basically replace diesel completely. It does not have to be blended with diesel such as biodiesel does. Renewable diesel is like it's called that drop-in, so it's more favorable to petroleum companies. They like it better than, say, a bio diesel. They're more in favor of it. And I want to highlight this because this is set for the potential of rapid growth in the next 5-6 years. So right now our capacity is at 791, and by 25 it's expected to be almost 6.5 billion. So crazy amount of growth. Not all of this is going to take place because some of these, there's a lot of it planned here, almost 4 billion of it is just planned. Those won't all come to fruition. They won't be built, it'll be slower than what's expected. So some of those things, but there is a potential for tremendous growth. Some of this renewable diesel will be made with soybean oil. I got a chart here coming up. This is just showing what's current, what's announced, and what's in construction. And then this group that was projecting that was saying, well, this is all of what's in the planning stages now. They felt it would probably be below 4 billion and maybe even half of that. Well, that's still a large amount of growth in this market. So it provides probably a new use for soybean oil. These are other oils and items that can fill that feedstock. Those, if it really would come out to this level, it would take an additional almost 40 million acres of soybeans. So that this top level is probably not going to happen. It just, I don't see it being feasible. I just thought I would share that with you. I've been hearing talk about it, and just wanted to share that little bit with you. That's what I have for today, and I can take any questions.
Okay. Any questions for Jack?